Hey, if you're looking to create a set of financial projections for a home services contractor business, so this would be like, think a pest control business, a lawn fertilization business, a painting business, a fence contractor, you name it, kind of any home services, residential home services type of contractor business, this template is built for you to help you create a set of financial projections for a potential investor or lender. So if you're trying to get maybe an SBA loan to try to launch your business and need a set of financial projections for that loan application, that's what we're going to help you get through here today. So I'm going to walk you through how to fill the template out and how it works. I will just mention that I'm going to show you two different templates or two different structures here. So when you purchase this template, we'll put the link to purchase in the description of the video below so you can go grab that. But when you purchase the template, you're going to get access to two different versions of the same template. Version 1 is going to be a single unit business, and version 2 will be a multi-unit business. And so the idea here is if you have ambition to have multiple units. So maybe you're going to start your first pest control business here in this particular city, but then you want to start another unit in a different city, and then a third unit in a different city, and kind of build your empire of pest control business, right? Through a multi-unit residential services business. This template's going to work for that. I'm going to focus most of my attention here on the single unit model because I think that's where you're going to start with the first unit, right? And that's probably what the SBA is going to want to see. If you're looking for an SBA loan, they're going to want to see how does the first unit perform, how's it look, and then you'll still be able to play around with here's what the 5-year plan could look like where we build out multiple units over time. So with that in mind, I just want to kind of set that expectation of what we're going to look at here in this video. Before I dive into the details of the template, if you stick around to the end of the video, as a thank you for that, we're going to give you a discount code, so a coupon code that you can use at checkout to take a discount on this particular template. And also, I just wanted to share a little bit of background why I am even recording this video. Who am I? So my name's Adam Hoeksema. I am the co-founder of ProjectionHub. We help business owners create financial projections for potential investors and lenders. I spent a little over 12 years as the executive director of an SBA lender where we made over 1,500 SBA loans during my time there. And so I come to this process with kind of that SBA perspective, that business loan perspective. And so we'll make sure that the template that you have here, once it's filled out, is going to be ready for an SBA loan application. We've got it structured so it's going to be ready for what you need to present to SBA. All right, so with that, let's go ahead and dive into how this template works. All right, so I am on the At a Glance tab here. And this is kind of the end of the process. So after we've got everything filled out, you're going to have some nice charts and graphs and tables. You can pull this into a business plan or a pitch deck for investors. You are going to have a 5-year income statement summary, a 5-year cash flow summary, a 5-year balance sheet summary, and then the income statement, cash flow, and balance sheet all broken down by month for each of the 5 years. So the SBA is going to require the first 2 years to be broken down monthly. And so we'll have that for you here, but we also have the rest. We have the whole 5 years all broken down monthly for you in case you want that detail. All right, so in order to produce these reports, we have a little bit of work though to do. And so this is the Input Assumptions tab. First thing you need to know is that every cell highlighted in blue is an assumption that you can change without breaking something in the model. So we're going to put our projection start month as January 1st, 2025. We're going to have location 1 opening in month 1. We have accounts receivable. So what this means how many days is it going to take you to get paid once you provide the service. So if you're doing all residential and it's like one-off services, you're probably going to get paid right away. And so that, in that case, you'd want to put 1 day. You're going to get paid the same day that you provide the service. If you are providing some sort of repeat service, like maybe pest control or like a lawn fertilization, you might provide the service and then then you'll invoice the client later and they pay, and basically if they don't pay, then you don't come back to provide the next month's service, right? And so in that situation, you might provide the service, invoice, and then it might take 15 days to get paid on average. Or it might even take 30 days. When you invoice someone, it might take 30 days, but maybe some of your customers pay on the same day. And so it averages out to be 15 days, for example, between when you provide service and when you get paid. So that's what this assumption is all about. On the accounts payable side, this is how fast you pay your bills. So if you get a bill in the mail, how soon do you pay that expense? So maybe it's, again, some things you're going to pay for right away. You fill up the truck with gas, you're paying on the credit card, right? Then maybe you don't pay the credit card for a month. So this is like, when does the cash actually come out of your account? So maybe it's 10 days, maybe it's 30 days, maybe it's 20 days on average, right? Okay. On the inventory, we're assuming this is a startup, so we're going to say we have 0 current inventory, but we're going to need $500 worth of inventory to start with, and then we're going to keep some amount of inventory, basically a month's supply. So if we say 100% here, this is going to basically be 1 month's supply of inventory that we're going to have on hand. And in order to get this off the ground, we think we're going to have to put in an investment of $50,000. And that could be a personal investment, could be investment from outside investors. We're going to invest that in month 1. And then we're going to have a few different fixed assets. So let's say we're going to rent some space for an office or maybe a warehouse. And we're going to call that leasehold improvements. We're going to have to make some improvements to the space, $35,000. And we can associate that with location 1 here. Life expectancy, 20 years. This is just what we use to calculate depreciation. You could probably just leave that at 20 years for leasehold improvements. And then you purchase that in month 1, or basically at the startup of the business, you're paying for that. Then we have location 1, tools and equipment. So let's say we're going to spend $15,000 on tools and equipment. Now, if you're buying a work vehicle, you could put in the purchase of the vehicle here as well. You can see we have a vehicle category, so you could add a row, select vehicle, so you could add that. But I'm going to assume for the sake of this model that we're leasing a vehicle, just for simplicity's sake. And then we have computers and software tools. So let's say we also spend $10,000 on some computers as well for the business. And then we're going to look at getting a startup loan for this first location of $75,000 with a 10% interest rate over 120 months. All right, let's look at our revenue tab. So again, let's just imagine this is a pest control business. We're going to start with 1 technician. So a 1 starting in month 1, and then we're going to hire our second tech starting in month 6, and then our third tech in month 13, and then every year after that, in the first month of the new year, we'll hire an additional tech until we get up to 6 techs for this location. We think the maximum weekly billable hours per employee is 35 hours per week. And we think the rate per billable hour is $100 for our service. And so let me explain this a little bit more. So let's say it's pest control, and you have maybe some regular customers that you go every month, once a month, and you're spraying. And so let's say you can work on 2 customers per hour on average, and maybe you charge each customer $50 per visit, per spray, or whatever, right? If you can do 2 customers at $50 a piece per hour, then your billable rate, your hourly billable rate is $100, right? So you might need to do a little math to kind of figure out, okay, what am I going to charge? Because you're probably not telling your end customer, this is what I charge you per hour. You're probably saying, I charge $120 for a visit. If I come out, it's $120. Okay, well then you're going to need to work backwards and think, okay, well, how long does my typical service last? If it takes 20 minutes to get there, 20 minutes to provide the service, and 20 minutes to go back home, that's an hour total, right? And so you're gonna, in that case, if you said it was $120 for a visit, it's not really, you're not making $120 just for the 20 minutes that you're there. You really need to consider the drive time and total, right? So what is the billable rate per hour that you think your techs can make as a whole, right, for the whole day? Okay, so 35 hours of billable time per week at $100 an hour gives us kind of, each technician is going to be bringing in $3,500 worth of production each week. This allows us to kind of build up to a full billable employee. So we're saying, hey, it's going to take a little time. Like once we hire this person in month one, we expect it to take 3 months for them to get up to capacity, and capacity is this, the 30, whatever number you put in here. So it's going to take 3 months to get up to 35 hours a week billable time. All right, so the rest of this is just kind of calculations here. Now on the cost of goods sold, so you've got direct labor and then job materials is how I have this entered in. So we're going to say for direct labor, we're going to say wages per employee per month is $2,600, and then benefits of 8%. So there's $208. And so just to be clear, this is monthly expenses per employee. So you see that right there. And so the model is going to check to see, okay, what month is it? How many employees do we have in the month? And it's going to apply these expenses on a per employee basis. So $2,600, and then benefits of $208. And then what I did with the job materials, so this is a little bit more complex, but essentially what I'm doing here is trying to take the billable rate of $100 an hour, and I want to assume that 10% of that is going to be 10% of whatever that billable rate is going to be a material cost. So it's going to be for the chemicals maybe that we're spraying or whatever, the supplies that we're utilizing in providing our service. So what I did was I took 0.1 times the billable rate per hour times 35 hours per week, and then times 52 divided by 12 to convert from a weekly amount to a monthly amount. So all that to say, I ended up in this situation calculating how much I think I'm going to spend on materials per employee. And ultimately it ends up being 10%. I just wanted to make it 10% of my revenue is going to be towards job materials. Okay, so, and we can apply an annual cost increase here of 3%. And the rest of this, again, is just calculations. All right, on this tab, we have input other expenses here. So this is things like advertising, accounting, credit card processing fees, insurance, supplies, right? So you get the idea. I've set several of these as a percentage of revenue. So you can set these expenses as either a corporate level expense, a per location expense, or a percentage of revenue. So advertising, I said, I'm going to assume we're going to spend 5% of our revenue on advertising. Accounting, I'm going to have $500 worth of accounting charges, but that's on a per location. So every time I open a new location, I'm going to have this new $500 expense. Credit card fees, 3%. Sales commission. So rather than adding a specific salaried employee that's a salesperson, I just said, hey, we know we're going to spend about 7% of revenue on paying a sales team. And so that comes through here on the sales commissions. Again, I had mentioned at the beginning, instead of buying a vehicle, I'm going to lease a vehicle. I'm going to estimate that at 3% of my total revenue is what I'm going to spend on vehicle leasing. And so the reason that this percentage of revenue works nicely is because as you add new techs, your revenue is going to go up, but so is your need to lease new vehicles. So is your need to have more fuel cost. So as your revenue goes up because you're hiring more techs, if you do these expenses as a percentage of revenue, that's going to automatically scale with you. So that will work really nicely. All right, let's look at our salaries tab. Now, here again, I'm going to show you in a second how we can do the multi-unit where you would have like a corporate level and then individual per location staff. But let's just say you're the owner, you're going to get paid $75,000 a year starting in month 1. There's just one of you as an employee. You think you're going to get a 5% annual raise. And then let's say you're going to hire, your goal is you want to hire a general manager. And so you've got location management and sales as the category here. They're going to make $80,000, but they're not going to start until month 37. So basically, you as the owner, you're in there doing the work. You've got a team of techs out doing work, but you're probably doing the selling. You're managing, right? And until month 37. So that's the beginning of year 4. Then you hire a general manager who can take on some of that responsibility. All right. So after all that, that brings us back to this at a glance tab. And the main thing I want to point out here is as you look at preparing this for an SBA loan request, I want you to look at the cash flow statement here and make sure that this cash at the beginning of the period here never goes below 0. If this is below 0, then you're out of money. And so it's not going to be a good look when you present that to a potential lender and you have negative cash at some point. It's going to look like, how are you going to make your loan payment, right? So if you need help filling this out for your particular model, or if you want to say, hey, Adam, I've got a set of plans here. This is what I want to do. I'm applying for a loan. This is the amount I'm applying for. If you want to tell us the details about what you're planning, we offer a service called our template fill out service where we can fill the model out for you based on your plans. So just reach out to us at support@projectionhub.com and we'd be happy to help you with that if you'd feel more comfortable having us handle that for you. But my hope is that through the video here, I've helped you figure out, hey, yeah, I can do this and know how to present this well to your potential investors or lenders. All right, so the last thing I want to show you is how this would look if you're doing multiple locations. So I've got the multi-unit version pulled up here. And so here's, let's say I'm gonna add in location 2, 3, and 4, opening one every 18 months. Let's say for the first 2 locations, I needed to invest some equity, but after that, maybe I don't need to invest equity anymore. The cash, just the normal cash flow is enough to cover the startup costs of location 3 and 4. Here I'm saying, okay, I've got leasehold improvements like for my office for each location that I open. Now, you'll notice here, I want to point this out. This is purchase month relative to location opening month. So since I've selected location 3 from this dropdown, if I put in month 1, it's going to look up here and say, okay, location 3 is not opening until month 36. So we're not going to spend this leasehold improvement money until month 36. Same thing with tools and equipment. So putting these all as month 1 just means that expense is going to happen when you start up that new location. Now there is a table. So yeah, I guess I should mention here, you can have loans for each new location as well. And this table down here will show you how much cash you need. And it's actually going to show you what your total cash available is as you open up each location and whether you have sufficient cash to open the location or not. So if this says no, if you don't have sufficient cash, probably means you need to invest more or you need to raise more money from lenders. Okay, so last couple of things. This is really all going to look the same because this is really just modeling out what one unit looks like, right? So that's not going to need to change. This won't need to change much either. But this is where now maybe you have corporate level staff because you've got 4 different locations, and so you say, okay, we're going to hire a CEO in month 25, and then in month 37 we're going to hire a CFO because we're going to have 4 of these locations and there's a lot going on, and so we need more corporate level staff. Again, you can have a general manager for each location that automatically gets added here. So this says number of this employee per location, right? So automatically in month one, when that new location opens, we're going to hire a general manager. So that's what this looks like. So in this multi-unit one, you can see you're getting up to 3.1 million in sales by the end of year 4 because we have multiple locations open. So I hope that has been helpful. If you have any questions or would like our help filling it out, like I mentioned, just reach out to us at support@projectionhub.com. And as a thank you for sticking around for this whole 20-some minute video, go to the description of the video below, and you're going to find a link to a form. If you fill out that form, we're going to send you a discount code, our most up-to-date discount code, so you can take a discount on this particular template. And as our thank you to you for sticking around. If you found the video helpful, please make sure to like the video and subscribe to the channel, so that will help us get in front of more folks like you that are looking to start a business and maybe get an SBA loan or raise some capital from investors. So we appreciate your support. And if you have any questions, support@projectionhub.com. Thanks.